Welcome to RHB Merge Podcast, where we share insights to help you make informed financial decisions. I'm Nova Lui, Head of Investor Advisory at RHB Bank. As we enter the final month of the year, markets often experience heightened activity. Investors talk about possible Christmas rally or year-end window dressing. While these seasonal trends draw attention, a deeper force consistently shapes decision and long-term results: the investor psychology. Investor psychology examines how emotions, habits, and instinct reactions influence financial decisions. Investors respond to discomfort, fear of loss, familiarity, or past experiences in ways that can shift their behavior and in turn affects the return. This is particularly relevant in December when portfolios are reviewed and adjustments are made before closing the year. In this podcast, we explore 4 common tendencies, their impact on portfolios, and ways investors can make more deliberate, informed investment decisions. Let's start with loss aversion, which describes the strong emotional weight of losses. Losing money, for example, 1,000, often feel far more painful than the pleasure of similar gain of 1,000. This can lead investors to focus on avoiding losses rather than pursuing long-term returns. A common example is averaging down on the declining stocks. Investors buy more to lower their average entry price regardless of fundamentals. The added risk is driven by emotional discomfort rather than rational analysis. They often sell as soon as the break-even level is reached. To manage this bias, investors should focus on the investment's current and future prospects rather than the original entry price. Each purchase or sell should be treated as a new decision. Correct behavior involves evaluating earnings potential, competitive position, and valuation before adding capital, instead of acting solely to erase past losses. Understanding loss aversion naturally leads us to another related bias: anchoring. Anchoring bias occurs when investors fixate on a specific reference point, often their original purchase price. This reference point can strongly influence perception, even when market conditions or company fundamentals have changed. For example, a stock may feel cheap simply because it has fallen below the price initially paid, even if the company's outlook has weakened. Investors may also hesitate to sell a losing position because it has not yet returned to the anchored level. Mitigating anchoring bias involves focusing on current fundamentals rather than past prices. Investors should assess whether the company still has solid earning potential, competitive advantage, and reasonable valuation. Correct decision-making treats each investment independently, letting objective analysis guide purchases and sales rather than past price memory. Once investors overcome anchoring, they often encounter familiarity bias, a tendency to gravitate towards what feels comfortable. Familiarity bias leads investors to prefer market or product they know well. Among Malaysian investors, especially those with Chinese heritage, will often result in a stronger tilt towards China equity, while markets like India or Japan receive less attention, even when analysts highlight them as a top picks with strong prospects. This happens because investors feel culturally connected, understand the language, and follow familiarity news. Meanwhile, exposure to less familiar markets are limited, which can reduce confidence in investing there, even when opportunities are strong. Reducing familiarity bias involves deliberately exploring less familiar market, reviewing diversified portfolio, and consulting research beyond the comfort zone. Correct decision making ensures allocations are guided by opportunity and fundamental, not just comfort. Even when familiarity bias is recognized, another subtle but powerful tendency often affects decision making: the confirmation bias. Confirmation bias occurs when investors focus on information that support their existing view while ignoring data and information that challenges them. For example, an investor convinced a sector will outperform may pay attention only to positive news while downplaying warning signs. This narrowing of perspective can lead to overconfidence and misallocation. The investment feels safer because negative signals are filtered out, not because the position is objectively sound. To counter confirmation bias, investors should actively consider opposing viewpoints and examine both bullish and bearish perspectives. Correct behavior involves integrating diverse information, letting evidence refine or challenge existing belief, making decisions based on a balanced assessment rather than selective confirmation. December is a perfect time to step back and reflect on whether investment decision has been shaped by bias such as loss aversion, anchoring, familiarity, or confirmation. Recognizing these patterns allow investors to make more deliberate and consistent choices. When portfolios are guided by analysis and long-term goal, outcome tends to be stronger and more stable. For deeper insight into market trends and opportunities, explore the RHB Merge Quarterly Fund Discovery Series. You may also reach out to your relationship manager for personalized advice. They can help you apply these insights to your portfolio so you enter the new year with clarity and confidence. Thank you for listening, and we look forward to supporting your financial journey in the year ahead.